So let's talk about one of my favorite topics, Section 1231. It's probably one of the most difficult topics, but I can explain it to you in less than 10 minutes. So Section 1231 is a sub-characterization rule. The idea of character in tax, as you probably already know, is that certain characterizations have preferences, right? If you have a gain, generally speaking, you want long-term capital gain because of preferential tax rates. If you have a loss, you generally want ordinary loss because there's less limitation and it can offset ordinary income at higher rates. Section 1231 has been called Taxpayer Nirvana, or I like to say have your cake and eat it too, because if it results in a net gain position, you get long-term capital gain. If it results in a net loss position, you get ordinary loss. So the best of both worlds, Taxpayer Nirvana. There's two parts to Section 1231. There's the sub-Hodge Pot, also known as the fire pot, and then there's the Section 1231 main Hodge Pot. The order that you do things in Section 1231 makes a big difference, a huge difference. So please follow the order that we go through this analysis on this video. So what you'll see on the screen right now is I actually have the two Hodge Pots. By the way, a Hodge Pot is like a bucket where you just simply net all the gains and losses from those events that relate. So let's go ahead and start with the Section 1231 sub-Hodge Pot. Section 1231 sub-Hodge Pot, the fire pot, here's what goes in here. Only specific involuntary conversions. So think about the general rules for getting capital gain or capital loss. Under Section 1221 and 1222, you need to have a sale or exchange of a capital asset. So that means that if you apply the general rules for capital gain, capital loss, it's impossible if you have involuntary conversion. That's where Section 1231 comes in and it says, hey, certain involuntary conversions, you can get capital gain or ordinary loss, because if you have a loss, you want ordinary loss. The sub-Hodge Pot, where we start, applies to certain involuntary conversions, not all, certain ones. So the first thing is that you have to hold the property for more than 1 year. Okay, you have to hold the property for more than 1 year. It cannot be personal use. So not personal use. So it must be business or investment, right? Finally, the last one is, remember I told you, specific involuntary conversions. Specifically, natural disasters like hurricanes, tornadoes, storms, floods, theft, and shipwreck. Involuntary conversions, where the property has been held for more than a year, it's not personal use, so it's business or investment, and the involuntary conversion results from natural disasters, theft, and shipwreck. So you could have different events that occur during the year, right? You could have a blizzard in February and a tornado in August. And maybe it creates a gain in one time, right, from insurance proceeds, and a loss the other time. You're going to put that gain and loss in there. What you're going to do is you're going to net. You're going to determine the net tax consequences. If it nets to a loss, so if the net position is a loss in the sub-Hodge Pot, then everything in the sub-Hodge Pot is going to be ordinary. Ordinary gains, ordinary losses, but the idea is that it's a net loss, and if it's a net loss, you want everything to be ordinary, because if you have your choice and you have a loss, you want it to be ordinary. If the net position is a gain, then what we're going to do is we're going to bring down all of the transactions, or just the net gain, whatever you want to do. I do at my problems, I just bring over all the transactions to show you, hey, look, we're bringing them all over to the main Hodge Pot. But you're going to bring them all over to the main Hodge Pot. So that's the Section 1231 sub-Hodge Pot. We always start with the sub-Hodge Pot. Now we're going to go over to the main Hodge Pot. So the main Hodge Pot has three things possible. Not all three things will be there, but three possible things. The first thing, of course, we start off with, if applicable, a net gain from the sub-Hodge Pot, right? We bring that over if it's there. If it was a loss, of course, then we wouldn't have anything. But if it's a net gain, that comes over. So that's the first item. The second item comes from involuntary conversions. And here are the specific rules that apply. Have to hold it for more than 1 year. Hold the property for more than 1 year. Cannot be personal use. And then it's all other Involuntary conversions, not from the sub-Hodge Pot. So really we're talking about the state and local government stuff, like eminent domain, seizure, requisition, condemnation, those ones. Those go directly into the main Hodge Pot. So the third item that goes into the main Hodge Pot deals with sale or exchange, property held more than 1 year, business, personal property that's subject to depreciation, amortization, and all business real property. So this is number 2 on our capital asset list and number 3 on our capital asset list. So that goes into the main Hodge Pot. You then net all the gains and losses. And when you net all the gains and losses, if we have a net loss, what do we want? We want it to be ordinary, and that's what we get. Everything will be ordinary. If we have a net gain, what do we want? Long-term capital gain or long-term capital loss, because again, each thing gets classified by that respective item. Let's just summarize. Generally speaking, when it comes to gains, taxpayers want long-term capital gains, unless you're a corporation and you're indifferent pretty much, right? When it comes to losses, taxpayers generally want ordinary losses because they're not as limited as capital losses. And also the tax rate play when you're offsetting a higher rate of ordinary income. To get a capital gain or capital loss, you have to have a sale or exchange of a capital asset under section 1221 and 1222. So that means that if you have involuntary conversion, it's impossible under the general rules. Or if you have pretty much any business property, right? Because number 2 and number 3 on our capital asset list, pretty much any business property is not a capital asset. Those would not get capital gain or capital loss treatment. However, section 1231 is a special rule that says, hey, well, we're going to allow certain involuntary conversions of property to be treated as capital gain or ordinary loss, but you have to hold it for more than a year. Can't be personal use. Natural disaster, theft, and shipwreck, that all goes in the sub-Hodge Pot. So we always start the sub-Hodge Pot first. We then net. If it results in a loss, everything in the sub-Hodge Pot is ordinary. Results in a gain, everything goes to the main Hodge Pot. Main Hodge Pot has 3 things. If applicable, right, if we do have a net gain in sub-Hodge Pot, everything comes down to the main Hodge Pot. Also, all the other involuntary conversions, so eminent domain, seizure, requisition, condemnation by city, state, governments, as long as the property's been held for more than a year and it's not personal use, that goes to the main Hodge Pot. And then finally, sale or exchange of business personal property that's depreciable or amortizable, or business real property that's been held for more than a year. So 2 things I want to stress. Everything that's in 1231 has to be held for more than a year. It's impossible to get into 1231 if it's held for a year or less. Also, personal use, never. Has to be business or investment. Business or investment. So that's really everything for 1231. That's the main aspect of 1231. Do some examples. I have some example videos where I go through this analysis and help you show. I use a chart that helps you show how to do 1231.